Good morning, my dear audience, and warmest welcome to the Impact webinar, Navigating Hydrogen's Next Chapter, Revealing a Practical Path Forward. My name is Ling Zhang, content producer from Lead Associates. It's our great honor and a privilege to be a host for today's event. As hydrogen moves from bold ambitions to practical implementation, the challenge now is clear. How can the industry regain momentum and scale in a commercially viable way? This webinar brings together experts from leading energy-focused consulting firms to decode the evolving hydrogen landscape, focusing on Europe, the UK, while drawing insights from the US, the Middle East, and the Asia Pacific. We will explore the next critical chapter in hydrogen's development, addressing market competitiveness, cost reduction pathways, and practical cooperation mechanisms across regions and industries. We are joined today by four distinguished speakers: Ms. Markus Wilthaner from McKinsey and Company, Ms. Erik Rakhou from Rakhou Associates, Ms. Mary Douglas from McKinsey, and Dr. Ming Lei from Resta Energy. During this webinar, I encourage all of you to actively engage in our discussions, ask thought-provoking questions, and share invaluable insights. There will be a question and answer session following each keynote, and while we may not be able to address every question due to time constraints, rest assured that relevant points may be revisited during the panel discussion later on. Please note that this webinar is part of the virtual content of Investing Hydrogen 2025, which will take place on September the 2nd and 3rd at London, United Kingdom. We extend our special thanks to our partners and sponsors, including Energy Transition Partners, RWE, Energy, Sustainability Partners, Air Products, Sustainable Port Partners, Port of Antwerp Bridges, Diamond sponsor, Lind, and much more, to discuss the latest innovation and fuel your business future by meaningful connections. To open today's session, we are honored to welcome Ms. Markus, partner at McKinsey and Company. As one of the leading voices shaping hydrogen strategy at a global level, Ms. Markus will share McKinsey's latest perspectives on the current state of the hydrogen market, a high-level overview that will help us set a common frame for the discussions ahead. From investment trends to emerging regional dynamics, this keynote will offer a strategic starting point for understanding where the global hydrogen landscape stands today. So, Ms. Markus, the stage is yours. You might share your screen.
Thank you, Lynn, and thank you everyone for joining this morning. Thank you also for the nice introduction. I am Markus Wilthaner from McKinsey, based in Brussels, and I co-lead our hydrogen team. I'm happy to share a few thoughts on where I think the hydrogen market and industry is standing and where we're headed. And I'm looking forward to the discussion afterwards as well. Let me share my screen. And I think you had as a headline for this webinar today, the next chapter, which I think is very, very suiting, because we have seen the hydrogen industry go through cycles of interest and then cycles of rationalizations before. And we are indeed now at the beginning of the next chapter. It's also a very confusing time in the market, an extremely dynamic time in the market, not only in the hydrogen market, but in the clean energy market and in the global markets more broadly. So I think navigating that and discussing and exchanging perspectives is extremely helpful. But let's maybe step back one small step, because we used to be in a honeymoon. We used to be in the hydrogen honeymoon, and that meant that year on year, we had many projects. We had developers rushing in, little bit like when you're on vacation in the morning, people with the towels running to the pool, securing the spots, and lots of announcements, lots of developments. It started really in Europe. It expanded across the planet. The US, with the introduction of the IRA, accelerated quite a lot. We had a lot of markets, emerging markets, looking as hydrogen as a potential to monetize resources that would otherwise not be developed in Latin America, in Africa, in Asia, and really to target then Europe as a market. And we had a tremendous amount of projects that were in early stages. So if you add this up, and the latest figures that we published together with the Hydrogen Council last year, it's about 700 billion that these projects would require if all of them would be built by 2030. Now, not all of them will be built. As in any honeymoon, there comes a time when the honeymoon is over and we realize some of the things that have been put forward are maybe not viable anymore. And we are in this phase right now. When we look at the traction, you have here the blue bars show how many projects have been announced every month, and this is in investment volume, so in $1 billion. In 2022, we still had 17 billion worth of investments every month on average. In 23, that's already reduced to 13. In 24, it reduced to 9. And we will publish a report later this year. We think there is a downward sloping trend of new projects that are being added to the pipeline. We've also seen a number of projects being delayed. We have seen cancellations. We have seen write-offs. So yes, many of the early stage projects, as in any kind of gold rush, there is a time when you rationalize. And this has been a particularly tough phase, not only because we are in this natural phase of sorting where bad projects fall away and good projects move forward, but we are also in a time of a massive macroeconomic shift, a change in interest rates that has put the whole energy transition on a much more difficult path. We have seen a time of very high inflation in costs, some of it because the technology and the complexity was underestimated, some of it simply because it's more expensive to build things than it was a few years ago. And third, we have seen a shift in policy and the shifting policy priorities, which means, well, on one hand, policy takes longer to materialize. We had very, very ambitious objectives, but then much longer timeframes to put that policy in practice. And now also major policy packages being questioned in terms of the direction. And this is particularly true, of course, for North America. So we've had a typical phase of an industry that goes through a cycle of lots of attention and then a more rational phase overlaid with these three trends. And that creates, that has made this turn in the industry particularly tough. I think this trend, and you read a lot about it, hides an underlying development though. And the underlying development is that if you look at projects that move forward, there is a lot of growth. So if we look at the white bar on this chart, this is the amount of projects that take FID. That number has risen in 24 quite significantly. And we will see where we land in 25, but the early projections look pretty positive that also in 25, that trend continues. So we have an industry that is moving forward, that is building projects. At the same time, we have also many projects that are delayed and that are getting canceled. So now you will ask, well, what projects are moving forward? If we look a little bit, if we double click on the production side for a moment, we have about 4.6 million tons of production capacity that has technically taken FID. Now, still that hasn't been built and not made operational. So even there is risk, of course. But if we look at projects that have passed the final investment decision and that are in process of being built up, then we have about 4.6 million tons. 4.6 million tons. And if you look at it on a capacity point of view, North America is actually leading. The reason is that North America is mostly focused on blue hydrogen and blue ammonia, where you can build quite large capacities relatively quickly. So North America has the biggest capacity today in terms of committed projects. China is a close follower. And if you look on the right-hand side in the investment figures, you see that China already surpassed North America by a margin, almost double. And this trend continues. So China is clearly leading on the deployment of green hydrogen capacity. These numbers are from last year. You have seen the tenders that have come out in China that are now more than 1.5 gigawatts. And just recently we had the announcement of round 2 of the government program, which targets even 6 gigawatts to be auctioned in 2025. Now, not all of those 6 gigawatts might be built, but even if only half of those get built, then China will clearly be the largest market for electrolyzers and the largest market for green hydrogen production. You have some activity also in Europe. these are mostly projects that focus the regulated demands. We will talk about those in a minute, particularly refineries. So these are smaller projects and mid-sized projects. Small, we typically say anything below 100 megawatt, and then middle-sized are around 100 megawatt. And we see a number of projects targeting the relatively clearly regulated demand in Europe around that comes from RED 2 and RED 3. We have published recently, together with the Hydrogen Council, following quite a bit of analysis, a look at what hydrogen markets are viable. And the way we did this is that we looked at, on one hand, what is the willingness to pay for hydrogen, which, as you know, there are many different applications, and the use and the value of hydrogen in this application varies widely because you're replacing something different, whether you're using methanol in the aviation sector, or whether you're using hydrogen to reduce iron ore, or whether you're putting hydrogen into a refinery. So the value of hydrogen is segment by segment different, and of course region by region, because the value of your substitute, of your alternative, is also different. So that's one thing. And then two, the important overlay of regulation that imposes CO2 costs or sets quotas to be fulfilled. For example, in Europe, as a refinery, you need to hit certain renewable shares, you need to hit certain shares of advanced fuels, and hydrogen is one pathway to do that. So what we've done, and we've tried to do that in a very granular matter, is analyze segment by segment, region by region, what is the value of hydrogen in use, and combine that with what is the cost of supplying hydrogen in that region. Again, there are huge differences, right? If you sit on the best hydrogen production source in the world, you may as well be able to produce hydrogen at costs around $4 per kilogram. Now, if you are in Central Europe, you're more looking at 10, 12, 15 euros. So huge differences. But if we cut those two, the demand and supply curve, we get to this curve, which tells us that depending a bit on where regulation lands, we would expect about 6 to 10 million tons. So the middle of the range is 8 million tons, 8 million tons of clean hydrogen that could have a positive business case by 2030. And that's the left-hand side here. So that is the market that people are chasing today, and that projects are also targeting. There is a middle segment in this chart, which is 13 million tons, where the business case is not quite clear, or it's an edge case. That means that the cost differences are at around $30 per megawatt hour, or $1 per kilogram. Or there are infrastructure that is needed to activate this demand. If we continue on the current path without future investments into infrastructure, without production cost decreases that we currently don't foresee, without additional policy, it's unlikely that these use cases will be in the money, but it could be activated if a step up occurs. And then there is another, so 13 million tons on the right-hand side, where hydrogen is clearly not in the money today with the regulation that is put in place. That means in some of these, hydrogen is the only decarbonization pathway. In others, there is competition with other alternatives. And depending on how important that is to policymakers, this could be unlocked, but it requires quite significant intervention, and is, from the current point of view, less likely to materialize. Now, maybe just a word on the left-hand side here. What is the stuff that really moves forward? Where do we see the most action? It is in particular driven by RED 2 in Europe, which is sets quotas in the mobility and refining sector. It will be driven in the next wave by RED 3, which sets the share of green hydrogen into industry. There are some uses in aviation fuel and in maritime. And there are the import schemes into Japan and South Korea, as well as a small sliver in the US, in the states that have the low carbon fuel standard. So those are, broadly speaking, the areas that are the most firm markets today, and where we see the offtake contracts being closed, where we see prices emerging and agreement on prices emerging the soonest. If we put offtake contracts, I just mentioned that, on a world map, where is who is buying, so to say. It's clear that Europe is the largest market today. Many of the projects that I talked about earlier in the US are targeting, and in Canada are targeting, the European market. This is in particular blue hydrogen, blue ammonia into the fertilizer industry. And then there are green hydrogen projects around the world that are targeting the European market. You have seen the projects in Egypt targeting H2 Global, and NEOM in the Middle East. There are projects also in China that produce, for example, methanol at very competitive costs now. And it's mostly European off-takers. So Europe is driving that market. There are now, we will add to this, obviously, the Japanese and Korean schemes that are currently prioritizing blue. But we will see in the future rounds whether there's also space for green. Interestingly enough, and maybe on a numbers point to reflect this, so I said earlier there's about 4.6 million tons of capacity that has taken FID. We expect, or we see in the economic analysis, that about 8 million tons from a current point of view could be firm. That means we need more projects to take FID to fulfill this demand. And if we look at the offtake side, then about 3 million tons of offtake contracts are out there in varying degrees of firmness. So really firm offtake contracts are more than like 1 million ton. Then there's 2 million tons, which we would consider relatively serious offtake contracts. But that still leaves a gap, both to those projects that have taken FID. So you can see that some projects that have taken FID have not forward sold all their output, as well as to what we need. And that means we will see in the next 1 to 2 years, will be an interesting phase to observe which projects are moving forward, who is signing off the contracts, and at what price. Because if you think about 2030 targets, we are into 2025. If you don't take FID today, if you don't take FID this year, you're cutting it very close towards the 2030 targets. So what to watch in 2025? Many things. It's a dynamic space, and any such list will obviously miss 1 or 2 more very important developments this year. But I think 3 things that we say that are quite important for what moves forward is, 1, the hydrogen auctions and the result of those hydrogen auctions, because they open a gate into the real economics of project developers. We have auctions now running in Europe. We have in the UK HAR2. We have the European Hydrogen Bank Round 2, which we expect very soon. There are separate auction rounds in Austria, Spain, and Lithuania. We have another EHB round later this year. We have Japan that is expected later this year, and we will have a round 2 in South Korea, and obviously also the auctions in China. So there's lots of auctions out there. We will see who wins. It's really the selection of the most competitive projects. And then I think also very interesting to look a bit in the rearview mirror, which of those that won the previous rounds are actually getting built and which projects are not, because that's the proof point that these things then really materialize. I think the second big theme is blue ammonia and fertilizer. The role of blue ammonia in the future of the European fertilizer industry, we think, is quite important. The European fertilizer industry is suffering from high gas costs, old assets, and the proposition to import blue ammonia into the industry is a very strong one. And this is also one that is outside of the quotas that could work basically on CO2 prices alone, we think, if implemented correctly. And the projects, there are quite a few projects, particularly in the US, vying for these exports. You can see some projects are better placed than others. And there will be also there a competition. Some will move forward, some will not move forward. And the last, of course, is policy. Policy one in Europe, we have the transposition of RED III. That is a member state by member state topic. Very hot discussions in a number of markets already. So that's something to watch. The gas market package, obviously, and the direction that the German government will set is also quite important. We see a lot of signs that they will be more pragmatic towards blue hydrogen, and that will set a tone, and also it will set a certain competitive field that other member states will want to emulate. So watching Germany is absolutely kind of a bellwether for the development of Europe. And then the future of 45V in the US, as we know, hangs in the balance. We know those discussions are live, and there are there are serious threats to 45V. So we will see whether that moves forward. As of today, this uncertainty in the US means that projects are not moving. People have developed projects. These projects are also, some of them are quite good quality, others less good quality, some are quite competitive, but they do need some sort of regulatory certainty. And with the current uncertainty, it's very, very difficult to make the case to take an FID. So we will see how the US moves. Let me stop it here and hand it over to my colleagues. Looking forward to the discussion and also to take some questions and provide answers later.
Thank you, Ms. Markus, for setting the tone with that comprehensive outlook. So these insights offer valuable context as we reflect on the evolving dynamics of this complex, rapidly changing sector. Due to time constraints, we would really appreciate it if you can type your answer in the chat box. There is currently one question for you in the box. So with that, we will now move forward to the next session. Now let's welcome our second keynote speaker, Erik, Managing Director, Rakhou Associates. With decades of experiences at the intersection of energy markets and regulation, Mr. Erik has contributed extensively to the evolving narrative of hydrogen in Europe. In this keynote, he will walk us through a high-level reflection on how market strategies are shifting as hydrogen transitions from vision to implementation. Let's take this moment to collectively rethink the frameworks, incentives, and signals that might shape the next chapter of hydrogen's commercialization. Hi, Erik. The floor is open for you right now. Welcome.
Hi.
Hi.
Should I share or will you be able to share?
Yeah, if you could share a screen, that would be great.
Okay, sure. I think this should work. Is it visible?
Yes.
So, hydrogen, where do we stand? I really enjoyed watching Markus tell the high-level story. I was also noting some words: cyclus, confusing, exit honeymoon, rationalizing gold rush. It's quite a gloomy picture out there. So, what should we do differently in this market? So the next maximum 10 minutes, I will spend to give some ideas from personal experience as both advisor and now also a developer over a 20 megawatt installation in Poland. And to already give away the conclusion, my key advice is start with sales of your project first. And what I will do is I'll offer you an how to do it, because I think it's very nicely also complements what Markus and also my other honored colleagues soon in this panel will be presenting. So just one word of introduction. If we haven't met before, my name is Erik Rakhou. I do quite a bit of things, but I do develop a 20 megawatt Hydrogen Rainmakers Poland initiative in Poland. I advise on future of energy and do workshops around it. I write books. I wrote one on touching hydrogen future with over 13,000 copies downloaded and still going strong with 37 co-authors. And I run a podcast, Global Tales of Carbon Transition. And I also do a lot of conferences. At least moderation is almost my hobby. But there is a serious note to it. What I try to do is actually participate not just in hydrogen, but in power grids, in nuclear energy, in circularity, in renewables. Because I think that the key problem of our energy industry is that we don't look across the fence. So let's look across the fence. What is the future of energy? And it's a need for all firm energy. And if you want to do deals in hydrogen, you need to understand what you're against. And an American developer very kindly published some of these numbers. And I just added a few of my own as well on hydrogen, and also the problems with all these sources of energy. Because frankly, I think we should remind ourselves that hydrogen is not the only energy source with a problem. Because if we had no problems, well, we'd just have one source of energy, wouldn't we? So onshore wind, yes, it can be quite cheap at $50 per megawatt hour. But how do you firm it up? And then solar, yes. A good friend of mine told me there is 80 gigawatt solar panels in a Rotterdam harbor waiting to be bought. Why are they still there? Well, it can take you 5 to 10 years to get a connection to the grids. So it's not that easy with solar and wind. Okay, then maybe natural gas. Well, it can be a glut and then it can be a shortage, as we've seen also with natural gas affecting fertilizer prices. And as an effect, hydrogen going into fertilizer industry varied between $1.4 and $5.9 per kilogram. That's quite a range, all because of the uncertain gas market. But yes, it can offer energy at a price, let's say $100 per megawatt hour. But then you discover that you need to wait 6 years to order turbines. So again, seems not that easy. Now, recently also with some co-investors, I've been looking to invest in small modular reactors. Again, once you dive in, and I just last night had a meeting with experienced lawyers around this, it easily takes you 5 to 10 years to permit to place a small modular reactor. And I think it's a good thing that we are very careful as communities. And then you also need to consider fuel, uranium, and how it's processed and what your reactor uses. Again, then we easily discover that it's actually not as easy as on a PowerPoint. And then, well, $130 to $150 per megawatt hour starts seeming an easy price. And then hydrogen-based CCGTs, something also occasionally discussed in Germany. Hydrogen-based power as a means of alternatives to storage. Well, my estimate would be we could have power then at 180 to 240 US dollars if we indeed get that hydrogen, as Markus also mentioned, in the range of $4 per kilogram. And as I also heard some other industry peers mentioning, we can work towards $3 per kilogram. So hydrogen, always think about it in context. What are the other problems? The key problem with hydrogen market, though, it lacks direction. So where do we go? Well, my key advice is start focusing on understanding how the sales process works. And as my contribution to this global dialogue, here is, together with my other associates of Rakhou Associates, developed simple overview how to do it, the sales process. And I think, to be fair, there are some very good advisors out there, and some of them are here today online, and they can help you to define that bias list. What you also really need to think about is what is your pricing strategy? And then you start with the meetings, thinking about shipping, logistics, arranging good lawyers, and getting deals signed. Is it doable? Yes, because at least even for my personal 20 megawatt, within 1 month, when I sent out requests for interest to roughly 20 players globally, my 20 megawatt project was able to sign 2 letters of intent for full production. So if you go about it in a good way, you can do it. So there are a good list to be made, right? Who are the buyers? And here is an example for those of you who are going after the ammonia market. You're welcome to take a screenshot of it. There you saw it. It also requires that you have a very clear view of what the market is. So what is the perception of the cost of green hydrogen? Indeed, it varies between 4 and upwards of 10. What are the targets that you see in the market, and actually feasible targets? I was just recently discussing with the team of Hydrogen Fuel Association from China. Today in China, $3.9 per kilogram is already there in the market, and they're working towards 2.25. In US, as we know, there is a target of 2. And well, some players, at least in US, are saying that at least 3 should be attainable. And then if we look to the way gray hydrogen costs have been varying, well, just based on historic data, it ranged between 1.4 and 5.7. So if you then look to the left, current green hydrogen cost, and you look to the right, where it's gray hydrogen cost, depending on what your view of the future is and the learning curves, hydrogen can be in the money. But having that conversation with your buyers is really important, and getting that shared view. So is hydrogen investable? Yes, in cases like fertilizer refining, steel making, but also long duration energy storage, as I pointed out, through the power game. There is also potential investability, and then there is the least investability. I think in this industry, we like ladders. Well, I developed here a pyramid. So let's coin it a Rakhou pyramid. There we go. But I think what is more important is to know what are you watching out for that is really going to drive change. Yeah, there are 3 things. It's what is the policy drivers, and I think they're next to things also very nicely summed up by Markus. I would also watch what the market leaders do. Define who you see as market leader in each segment and see what are they doing and copy them. It's absolutely okay to be second. Then about timeline and scale and uncertainty. What is really key is that we continue to build infrastructure. I really like the RWE Total Energies deal and the connection they made on how the infrastructure is timed to link that refining and production. I think that is one of the key learnings in that. And I think we should also, from the regulatory perspective, allow collaboration despite whatever unbundling limitations there may be. And then finally, economics. Yes, we will need subsidy and policy mandates first now in the next 10 years. But this is exactly what we've done in renewables and biofuels. So let me leave you then with the following. I think we should continue to break silos, and at least as my contribution on it, I'm writing a 3rd book, Smart Energy Hubs, about how molecules, electrons can collaborate to achieve industrial competitiveness. I do that together with Robert Franke and Peter. And if you want to talk about it, I already have some interviews lined up. Do reach out to me. Then secondly, I think we need to share learning curves about the technology, because there are learning curves. And to work on this together with my investors in Hydrogen Rainmakers Poland, we'd like to consider developing in Poland a hydrogen museum. So if you're interested to contribute with your technology, do reach out. And finally, this is a common goal for all of us here. I think we should work on accelerating global sales. So start with sales first, and then do your engineering and your finalization of permitting. Because if you don't sell hydrogen, why are you investing millions in engineering studies? There is enough engineers if you do have sales. Thank you.
Thank you, Ms. Erik, for your insightful keynote. As we've heard, the hydrogen market is entering a period of recalibration, one that may demand redefined roles, refreshed policy signals, and new forms of cross-sector coordination. These ideas set a valuable backdrop for discussions ahead, where we'll continue to explore how industry, finance, and policy can better align to support scalable growth. During the presentation, we've already received questions from the audience. I'm sure they're seeking to have your answers. So, question 1, how do you view India's ambitions to become a major green hydrogen exporter, particularly with Europe as a key target market?
I think every ambition needs help. So next, what I see in the market, it's not just India, it's countries like Oman, it's countries like Mauritania, it's countries like Morocco, it's countries like Brazil, it's countries like United States, which was just mentioned, or Canada. And all of these geographies, this is just a very illustrative list, all are battling for how do I reach my markets? So the ambition is very positive. I also already noticed that ambition from the global downloads of Touching Hydrogen Future Book. India is number 4 globally out of 200 countries where the downloads are happening. Obviously, there is also something of a statistical bias with many inhabitants there. But I think it's a very promising development that hydrogen is picked up as a way to address part of the energy challenges as part of the mix in also a country like India. So very much welcoming to the global stage for hydrogen, but just to my Indian friends, you're not alone. Thank you.
Thank you, Ms. Erik. Many thanks for your very detailed answers and participation in today's webinar. I look forward to hearing more of your insights in the panel. And there were 2 more questions in the box. We would appreciate it if you can answer them. So,
of course.
Right, thank you. So our next keynote will bring us closer to the operational realities of hydrogen development, particularly in Europe. We are pleased to welcome Ms. Mary Douglas, Vice President and Head of Hydrogen Research at McKinsey. Drawing on his deep market insight and global research experiences, Ms. Murray will explore how strategy can be translated into concrete action, particularly in building competitive and resilient regional hydrogen supply chains. This will help set the stage for practical conversations about production, infrastructure, and demand hubs. Now, Ms. Murray, let's welcome him on stage.
Hi, can you hear me okay? Thank you.
Yes.
Fantastic. Right, I'm just going to share my screen. Hopefully that is coming through okay now for everybody. Okay, fantastic. Well, look, good morning, good afternoon, everybody. Thanks very much for joining the call and for the invite onto this webinar. I'm looking forward to the discussion afterwards. So let me try and skip through these slides as promptly as I can, because what I really wanted to do was start off just reflecting a little bit on the post-FID low carbon hydrogen landscape. There's probably going to be a little bit of overlap with what Markus has already spoken about, so I'll move through that quickly. And then I just want to talk a little bit about some of the success factors behind those project FIDs, because that's very important for us understanding what's going to come next. Alongside that, obviously the important thing and what's really been helping with many of these projects progressing is the support and policy mechanisms that are underpinning many of the project FIDs, and that's something that certainly through the rest of this decade and even into next is going to remain really important. So look, I'll start off with something quite basic in the sense that, you know, just almost a bit of a reminder of how far we've come in actually a very short space of time. There is, of course, a lot of gloom in the industry. There's a huge amount of challenges in the industry, but nevertheless, you know, in terms of the investment that we've seen in this space, you know, Markus already talked about the billions of dollars that we've seen invested into post-FID projects. That figure does continue to grow, albeit it is beginning to slow down slightly. You know, I think when we were presenting these sorts of slides just a few years ago, there was a lot of emphasis around the amount of announced capacity in the market. You know, post FID, we're just about 4% of that giant 150 million tonne per annum plus announced low carbon hydrogen project capacity. Probably the most important thing now is that we've taken FID on around 6% of the equivalent of the carbon intensive hydrogen supply in the world right now, and that's probably the more positive signal. However, you can begin to see that this year in particular, when that gloom is really coming through, that things have certainly started to slow down. Granted, we are only in May, but there is kind of very clear evidence that we are seeing a little bit of a slowdown. Some of these policies are taking longer to come through to fruition. With, you know, CF Industries' Blue Point project was really the one thing that's certainly moved the needle a little bit this year in terms of FID, alongside maybe Repsol's Tarragona Eco Plant project in Spain. We do think that figure will grow further through the year, particularly maybe from some US Gulf Coast and Middle East blue hydrogen projects coming in the second half of the year. Just quickly, showing how that looks split across the gas reforming projects and the electrolytic projects. we are seeing that quite heavily weighted towards blue projects at the moment in terms of what's coming through, and that's no real surprise. You know, Erik has already spoken about where those costs are at the moment, so we are just seeing more progress in that space. What we do need to remember, though, is not all low carbon projects are as low carbon as one another. You know, certainly that share of the blue post FID includes a number of retrofit projects onto existing SMR, and so the capture rates on those are going to be much lower than some of those greenfield ATR projects that we're seeing coming through. What we've also just highlighted here is the share of Europe across the blue and the green space, where, you know, certainly unsurprisingly, again, taking a lesser share of the blue hydrogen that's post FID, but beginning to lead a little bit more on the green space. And we expect Europe to continue to progress due to some of those RFNBO requirements that we see specifically in the European market. Perhaps what becomes a bit more interesting is when we look into those post FID projects in terms of what companies are actually doing. And we can see quite clearly that it's actually been Air Products that dominate that post FID pipeline. However, it's also worth noting, as I'm sure everyone in this webinar has been following, that Air Products has been under significant pressure over the last 6 or so months. And indeed, we have seen a material change around their executive as a result of that. And, you know, further scrutiny on those projects that did take an investment decision, particularly for those, and it's been mentioned already, that have quite significant volumes that are still uncontracted into the market. And it really builds on that point Erik was making, that you really need to get the offtake, the sales lined up before taking FID. And certainly those developers that have taken FID ahead of locking in that offtake are facing considerable pressure right now for those very large capital commitments that they have made. We're also seeing, we're seeing all of those legacy industrial gas players build up quite material positions. Probably the Euro majors, the US majors, lagging a bit behind that, maybe versus some of the ambition that they showed previously. We think certainly for those Euro majors, we're still, and some of the downstream developers, still very strong incentives in the European market to decarbonize on the refining sector side as well. And this right-hand chart here just shows that very clearly when we're just breaking that down in terms of allocating those post-FID volumes into the different end-use sector. It's actually the export volumes that dominate. That's primarily some of those blue ammonia projects out of the US Gulf Coast and the Middle East, which are targeting export markets, whether into the European market or trying to catch those Northeast Asian auctions from Japan and Korea. But I think what we've also just added on there is a simple piece showing the European share of each of those sectors. And the thing that does jump out quite clearly is on that refining sector, the European post-FID capacity accounts for a much larger share than versus some of the others. And that's really down to those policies, the targets that the European Union has in place. So there's a very clear investment case to decarbonize that refining sector, particularly through green hydrogen. And that's where we're continuing to see more and more progress. And we've seen, very strong progress, particularly in the German market in that sense. What we wanted to also look at was, maybe a bit more of a qualitative assessment of, trying to look at each of those projects and understand, right, what has been the principal success factor behind that project actually making an investment decision. And so we've really broken this down, and there's a wide range of factors that we think have principally underpinned the investment decisions at these. What we see is very clearly leading is anything around that production subsidy tax credit side, where, and that's particularly around most of those US Gulf Coast blue projects that have progressed. That's, that 45Q that's in place is still the principal driver of FIDs in that market, as is the ability to capture some carbon cost avoidance if they can take that blue ammonia into the European market, as we see ETS allowances removed, free allowances removed, and the implementation of CBAM. It's still a principal driver of some of that investment that we've seen coming through. If we actually look towards the bottom of this chart, what we also think through the longer term we'll start to see more from is one, on those double-sided auctions, we should start to see that begin to pick up as a bigger driver of investment decisions, as we will around the penalty avoidance. And that's principally around things like Fuel EU Maritime, where we think that is a longer term play, but we will begin to see more projects taking an investment decision in order for shippers to avoid some of the penalties that are coming down the line in some of those sorts of sectors. We've just picked out essentially a selection of maybe some of the higher profile subsidy schemes that are in place at the moment. And the reason for just putting this up is also to give a bit of a reminder that, policymakers have been extremely busy in the last few years, and from almost a standing start at the beginning of the decade, rules and support mechanisms have been designed at a very, very rapid pace. That has taken time, but it's only really now that we're beginning to see, when those support mechanisms were actually announced through to when they're being awarded and finalized. And so even where those awards or tenders have been awarded, it's actually still then taking a further time for the FID on some of those. And, the UK HAR1 or the European Hydrogen Bank are key examples of that, where we have seen awards quite some time ago, but we're not seeing the investment decisions come through yet, because there's still, quite a few hurdles to cross for a number of those projects. But we highlight this again, just to really underline that, the policy supports are there. In many cases, they are robust, but they are just taking longer for developers and governments and policymakers to work through and bring those through to final. The last slide I just want to touch on, and I won't spend much time on this, but it's also just to underline the importance of subsidy schemes, tenders, auctions. And this is actually just a selection of the European ones, but it gives a snapshot of just how much is out there. And we actually spend at Wood Mackenzie a lot of our time working with our customers to help identify the tenders, the auctions, the options, which one can actually offer the stronger investment case for a project. And we're already seeing examples, like CIP's Catalina project in Spain, where it was awarded through the EHP, but it's also been awarded Spanish government funding. And it's going to have to take a decision on which of those to take. Certainly our valuation modelling suggests that it's probably much more likely to take the Spanish government grant, as it does offer a better return. So it's just to really highlight that vast landscape of tenders, auctions that are available to developers, and a lot of time should be taken to work through these, understand them, and just really understand if it's what is the optimal for that particular developer. So just wrapping up, I won't spend too long on these, but I think despite the challenges that the market right now is facing, the market is developing slower than what we had maybe all hoped for, but it's still moving forward. The post-FID capacity has been driven by quite a wide range of project success factors, but it's clear that there's a huge importance around subsidy schemes, and that's not going to disappear anytime soon. And then finally, we just need to remember we're still very, very early stages. The whole policy landscape still lacks maturity, but there is a lot out there, and there's a lot more coming through the pipeline. So thank you. I'll stop there and pass back to you, Lynn. Thank you.
Thank you, Ms. Murray, for sharing the comprehensive perspective. Your remarks underline the importance of aligning ambition with execution, a challenge that is especially relevant as regions seek to define their own hydrogen pathways while staying globally connected. This discussion adds valuable grounding as we shift into deeper exchange on technical, financial, and policy levers. Here I also have some interesting questions from our audience. We can't wait to hear your answers to this question. So, question one, to what extent does green hydrogen need subsidies like solar PV so that it is competitive with conventional hydrogen prices?
Yeah, so I think what we can see quite clearly now is that the answer that any green hydrogen project is absolutely dependent on some form of subsidy, whether that is a CapEx grant, whether it's a CFD, whether it's some other auction mechanism, or what we also need to remember, there can be other support mechanisms put in place, whether that's a free and low cost interconnection onto the grid, So there's loads of different ways that policymakers can support green hydrogen projects, but I would say that certainly this decade, you know, if every green hydrogen project of any materiality is likely going to require some form of subsidy, or you know, it's going to have to find an off-taker with a very high willingness to pay, and I think that's quite hard to understand where that's going to come from in the near term.
Right. Thank you, Ms. Mary. Thanks again for your generous answer, and I very much look forward to witness more projects and policy being implemented in the future. So next, as the hydrogen sector navigates a period of recalibration, questions around investor confidence, policy reliability, and the commercial timelines have moved to the forefront. To help us reflect on these dynamics, we are pleased to welcome Dr. Ming, Vice President and Head of Hydrogen Research at Resta Energy. In this keynote, Dr. Ming will offer a broad framing of the key signals and structural shifts that may be needed to rebuild market momentum and restore clarity for industry decision makers. Dr. Ming, welcome on stage.
Thank you very much for the invite to this webinar. I think it's quite fantastic that we have many of us analysts all together. Of course, many of the panel on industries, mostly sometimes developers, bankers, sometimes off-takers, but never a group of analysts sitting together and discuss our forecast. So that was quite exciting. Many of my colleagues on the webinar today has go through, you know, the state of the hydrogen sector, you know, the list of FIDs, the numbers and things like that. And when I was asked to do my part here of talking about rebuilding market confidence and, you know, finding the answer to help hydrogen, make hydrogen great again, if I were to say so, then I kind of want to think more about, you know, how things have failed, because we do need to learn from our failures to be able to move forward. So that will be kind of the key part in my talk today, but kind of presenting the same screen with many of my panelists today. These are the projects that we've seen announced over the past few years. And as you can see here on the little chart that I have on the right-hand side, the number of announcements has been reducing a fair bit, and we're expecting 25 we'll see a lot less announcement, as well as in 26 and beyond as well. The industry now is moving into trying to execute this project, but I think as we discussed today, we also realize that the understanding and maturity of the market has also come into play to understand what project works, what is the right demand sector, at least in the early days for hydrogen. So if you were to alternatively look at this map, and not by the type of hydrogen production process, but instead by the status of the projects, instead of kind of maybe going through the project that has moved on to FID and under construction, I want to highlight the project on this map here that is in brown, which are the project that has been suspended or canceled. So you can see here right off the bat that many of these projects are actually quite large in size, and also they are concentrated in certain areas. Australia, my home country, is not really doing too well in this map, in this case, and so it's many of the projects in North America as well. But actually, in terms of those projects that has been canceled, we keep hearing in the media, those are only representing about 7% of the projects that are in the pipeline. Yes, you can see that there are still about 90% of the projects still stuck in the concept or planning phase. But as I think Erik mentioned briefly, that is the same story for a lot of the new energies, from solar to wind to offshore wind projects around the world. So hydrogen, I think part of the reason why this pipeline are a bit inflated is because the projects that normally being announced are very, very large in size, right, in gigawatt scale. And of course, another thing, especially looking at this map, many of these projects are aiming to export hydrogen into a market where the demand is not existing at the moment. So that goes with the challenges in this case. But if we were to look back a little bit here in terms of the last few quarters, I started from first quarter 2024 here and now into the first quarter of this year. What you can see is, yes, there are big bars of this suspended and canceled project that started from the third quarter of last year. But there's also a steady pace of FID and construction, and many of my panelists today has mentioned kind of that steady pace that we've seen so far. So if you were to put this again in perspective, if you compare to solar, it takes them about 10, 20 years to go from 1 megawatts to 10 megawatts to 100 megawatts. And here in hydrogen side, we try to go from basically nothing to 100 to 200 megawatts in a very short amount of time. So the scale is already, I would say, impressive with respect to other form of new energy. But in the grand scheme of the hydrogen side, still fairly small. So if we were to then focus on those projects that has been suspended and canceled and look at why they've been canceled, there's actually quite a wide range of different reasons that developers put forward, right? And here in the pie chart are just highlighting those reasons. The biggest ones, as you can see there, is the lack of demand. And I think that's really echoing many talk around the industry. There's really lack of off-takers, but you know, as we go down to other reason, I think it's also interesting to point out that certain strategy pivots as well. Many of the big owners of these projects are also starting to change a little bit of their strategy, push back. So that also have an impact on some of the biggest projects that we see announced. Costs can also be attributed into this demand side, right? How to bridge that cost gap, the lack of subsidies in certain projects also contributed to this as well. But I think outside of that, there's also some technical challenges that we will start to see emerging. Well, Erik mentioned a bit about the power side, and we do see that as well. A lot of projects are getting denied access to the grid, cannot get the PPA that they need for their projects at the right price, at the right terms and condition. So that's also something that need to be highlighted as well. So if we were to then kind of looking for answer out of all these cancellation reason, trying to see how we can tackle these problems, then we will need to discuss a little bit on each of those. So before we go into that, if we then use these projects that, you know, the reason why project being canceled, or as Murray put it, the reason why project move on to FID, there are certain criteria that projects will need to meet, I would say, in order to be less riskier for developers and also for financiers to move this project ahead. So across, you know, these projects that we cover in database, Rystad Energy, my team do look at about 18, 17 different criteria and score these projects on those to find the right risk for these projects, and things that are very impactful, such as whether the project has already secured offtake, right? What type of fundings they have. Are this project close to demand sides at all? So those are quite impactful. Another thing is also the developer history as well. We do see a lot of startup company building, announcing projects and then fail to move that ahead. So that's also need to be considered. So in a sense, that 100 million tons pipeline that we have for clean hydrogen could be reduced to about 40 million tons. Depends on how we see low risk and high risk projects can be moved on. And this will also be different by different continents as well. Asia generally, as you see, already have a bit more appetite to tackle this risk, as opposed to projects that require traditional project financing in Europe, for example. So let's look at a few ways to think and tackle some of these cancellation reasons. The lack demand is quite clear, and I think you know, when hydrogen first come into the height of the interest about 2022, 2023, one of the terms that been put out a lot is the Swiss Army knife of the energy sectors, right? So in a sense, hydrogen can be used for a lot of things, but there's also the dilemma of so many choices, right? And that kind of bring the challenges here. If we look at projects that are planned to be built by 2030, only 10%, or well, 10 million tons of the projects has had any sort of off-takers. And this could range from projects that are getting MOU, LOI, all the way to binding offtake. Many of them are actually self-offtake as well. We see more than 80% projects with off-takers actually in this bucket of self-offtake. And in terms of where these projects are being used, traditional use of hydrogen still reigns supreme in a way, right? Chemical industry, so ammonia producers are here, refineries are here as well, but then we also see some other use cases that are a bit smaller. Iron and steel, power use case do have certain off-taker tied to them. So there's the need for us to also recalibrate what is the right use case, right? Back in 2022, many of us on the analyst side have a certain type of consensus that we will see a lot of hydrogen demand, right? 400 million tons. The IEA also put the numbers around that bucket as well. But I think now with the understanding of where hydrogen should be used, our base case now is looking into 2050 about 200 million tons. But in a sense, also I also show here the high case and the low case. There could be more upside to the hydrogen story as long as we continue to put on forward the agenda for energy transition and climate. Because make no mistake, the whole point of doing clean hydrogen is about climate. Right? So that's something that we need to consider. As what about the cost gap here? I think many of us has pointing out the cost gap, especially for renewable hydrogen to the fossil fuel-based hydrogen production. The cost gap is big. I think there's no way of putting around it. There's of course details about certain regions that can produce this cost a lot lower. But I think in terms of getting across this cost gap, it could be a two-pronged approach, right? So not only providing credits and support on the production side, but we also need to do something on the demand side to boost the willingness to pay. In terms of production side, this is traditionally and historically, we see a lot of fundings in this space, CAPEX funding, OPEX fundings in production credits and so on. Unfortunately, this morning I was reading through the news of the new tax package from the House GOP in the US. 45B seems to be out, but there is nestled in it potentially, other type of credit that could be utilized. But Europe's still looking strong, and we see India with these auctions and subsidies as well as among, I believe, Australia now with the new government should also continue with some of these. But what about the demand side? I think this is what has been a bit missing in terms of the story. If we were to talk again about renewable energy sectors, there were some demand push, right, portfolio standards and things like that to kind of bridge this gap. And we need to see the same thing for hydrogen and derivative space. And we do see some of that in Europe. And hopefully as this year move on, we'll start to see some of implementation and clear indication coming forward. And again, these targets are all about climate, right? So kind of reducing emission from the shipping sector, from aviation sector through Fuel EU Maritime, Refuel EU, for the renewable energy directive for industry and kind of transportation use as well, that we start to see certain countries coming out with the penalties. And this could really help with the business case for many of the clean hydrogen projects. In terms of a global perspective, we do have certain mandates in Japan for ammonia co-firing, and China now coming out with a few mandates as well. And I think the recent target from the IMO is also a positive sign, because that's one of the first global mandates and penalties that could be used to boost the use case for hydrogen globally. Yes, there will be still challenges for green ammonia, to really bridge this gap with the current penalty, but there could be way that you can combine many different credits and production support to bridge this gap as well. If we look at the case of Europe here and how this kind of targets has impact things, and we clearly see that it has an impact, because most of the top projects in Europe that we've seen so far that has been successful are all providing clean hydrogen, and many of them green hydrogen, to refineries, and kind of on the back of these red requirements. So that's clearly, we see the mandates at work right there, because other regions, the use of green hydrogen in refinery is very small compared to the case in Europe. And another part for the cost gap is, of course, to talk about supply chain. And many of us also, look into the case of hydrogen cost, electrolyzer cost in China, that is significantly cheaper than compared to Western electrolyzer. There's also, a bit of devil in the details on how certain auctions are carried out in the market in China, are pushing for some of these prices. But nevertheless, we do need to be able to look at potentially be more flexible with sourcing our equipments to be able to continue pushing down the prices further down the curve. So this is some of the ways that we can look at the cost case, right? And I think beside all the different mandates, all the different type of cost reduction we can look for, there are also potential opportunities that are a little bit harder to find that is not relying on this. And that is generally a result of a changing power sector and changing energy system. For many countries, the energy transition is very much on momentum and it will be hard to stop. For Europe, for example, with the growth of renewables, we continue to see a higher occurrence of negative power prices across the continent. Generally, this means a good business case for batteries and so on, but there could be a case there for hydrogen, for electrolyzer, for grid balancing, for example. And many of the success story that we see that doesn't kind of rely on a single offtake that we see for hydrogen projects does utilize these dynamics of system integration, of kind of leveraging the power market, of leveraging the heating market, of leveraging the chemical sector all together. So really using this kind of Swiss Army knife effect here to create business case. Yes, a bit challenging, but I believe that will be a good challenge for many of our project developers to solve. So that's pretty much some of the points that I want to touch on today on the topic. I'm not sure if there's any other question, but I know that we have also the panels coming up, so we can save it for those as well, I suppose.
So yeah, thank you, Dr. May. Many thanks for the kind sharing, and I'm sure this is a very solid presentation for our audience who are eager to get insights and lessons from you. So due to time constraints, let's just move on to the panel. So as the hydrogen sector scales, the need for practical and effective collaboration becomes more urgent, not just across companies, but also across regions and governance systems. This panel brings leading voices from the strategy and the research side of the hydrogen transition. So Ms. Erik of Rakhou Associates, Ms. Markus of McKinsey Company, Ms. Murray from Wood Mackenzie, and Dr. May of Rakhou Energy. Together, they will explore how different stakeholders can move beyond high-level alignment and begin building specific outcome-driven cooperation models that support a functioning hydrogen ecosystem. So hand over to you, Ms. Erik.
Well, thanks a lot. And what a fantastic star panel we do have here. So it's the combined rigor of looking at hydrogen market today is really very high. So I hope we get actually questions that are equally complex. So do start posting them in Q&A. What we'll do now is, as a format, I will ask each of our dear panelists here, and so Markus, Murray, to do a 1-minute opening statement, also reflecting a bit what they heard from the colleagues and focusing on one question. Yeah. Should we feel gloomy? And if so, why? Or not? So, Markus, you had the most time to rest from your presentation. So why don't you start with your minute?
Excellent. Thank you, Erik, and nice to be on this panel. Should we feel gloomy? I mean, no, we shouldn't, right? I think I think we should be realistic. I think there was an expectation that this would be an easy ride, right? That this would go faster, easier, that there would be lots of money to be made without hard work. And I think it's the time of rationalization where we realize that this is a very competitive space, where it is hard to scale new technologies, where it's difficult to find financing for first-of-a-kind projects, where it is difficult to convince off-takers to sign contracts. I hear you, Erik, start with the sales. But when you start with the sales, you need to find an off-taker who wants to take a decision under uncertainty. So that is also not easy. So I think this is a difficult puzzle piece to put together a new industry and to scale it up. So we shouldn't feel gloomy about it. I think there is a lot of opportunity for markets that are emerging. I like the numbers and the analogies. I think Murray, you brought it in versus the solar industry. This is growing very rapidly, right? And so I think there's a lot of opportunity, but I think we should be realistic in terms of the returns that we can expect in an early industry. Some people will make good returns, some people will not. in the reliability of new technologies. If you deploy a technology for the first time at scale, some of it will fail, things will go wrong. So we need to plan for that and have a realistic approach to it. So not gloomy, but realistic. And also I think there is a lot of noise in the industry. Should we do hydrogen or electrification or carbon removals, or should we go back to fossil fuels? I think in the end, we will need all sources of energy, and we will need all sources of decarbonization if we want to move forward. So I think the notion of being gloomy and then not doing anything is the wrong notion. The notion of being gloomy and focusing everything on another card is also not a good notion, because you're just gonna increase your risk. So I think staying optimistic but realistic is what I would say is the right direction.
Thank you, Markus. Very helpful. Murray, on the same question, continuing. So what's your take on gloominess?
Yeah, well, look, I think a really important point to note as well is that this isn't, some of the challenges that the low carbon hydrogen industry is facing is it's not specific to hydrogen, right? This is like a kind of broader energy industry and specifically around the transition technologies, where you've had over the last few years incredibly high levels of cost inflation. We still have very high borrowing costs across most of the world. Inflated labor rates, etc. Right, so there's still a lot of just big cost challenges out there. Meanwhile, on the flip side, that kind of willingness to pay hasn't quite picked up yet, and that's where I kept harking back to, is that the policymakers have this really important role to play in terms of actually having to try and join those two things. And of course, through time, costs are going to come down. I just think we all need to be realistic about what level those costs can come down to. There's no point in promising the world that we're going to get to some unrealistically low cost basis, and that's again why you need to good policy design to get those incentives in place, but also the carbon costs, the other penalty costs that if we give companies enough time to understand what they need to do around penalty avoidance, it also gives them time to structure the projects, to structure the offtake, to transition on the offtake side as well. So I think like Markus said, and we've all said, this is always time. This was always we always raced into this ahead of ourselves in many cases, and I think where the industry now is in a much more pragmatic place about what kind of volumes we can bring to market this decade, and actually which sectors actually need low carbon hydrogen, because we should remember as well, some do absolutely need it, some definitely don't, and there's a lot of people chasing some of those sectors that simply don't really have a requirement for low carbon hydrogen.
Yeah, it's true. And speaking to some of the sectors, they do feel chased to, for example, for those chasing cement players, it seems they at least are now much more active in carbon capture and less so, I would say, in hydrogen. So I think it's quite important to know who to chase. Let's start with that. I hope people get some good advice about that. Saves a lot of time. Thank you, Murray. Min, yeah, gloominess. You started to offer in your presentation, I think, also some insights how we go about avoiding it. Would you like, also having heard the peers set some of the visions, any reflection on gloominess from your side?
Yeah, no, I agree with my fellow panelists here. Things are happening that we see now is more of a recalibration, as well as general challenges for the industry as a whole, especially with a few certain government changes that we see for some key countries and key players. But I currently live in Norway. We do have a very long winter, but the summer is fantastic. So I guess that I just want to highlight a point that among these challenges that we see here, we'll also see some success story. And of course, with our goal here to push to reduce our emission, hydrogen would definitely have a role to play. When we look at traditional use case of hydrogen, it's all about feedstock, right? It's all about making molecules that require that hydrogen content. And I think going forward, that will still be the key use case. And I think there's a question here in the chat as well. Will the hydrogen demand just stuck at 100 million tons? And we see that most of those gray being replaced by blue or green. I think when we look at other sectors that will need to use hydrogen or derivatives, they will be growing on those demand, right? Shipping sectors, I think methanol is getting quite strong momentum now. Ammonia is also a little bit behind, but definitely there. And of course, for the story about sustainable aviation fuel, right? If we just ignore the e-fuel for a certain moment, and look at the biofuel, you still need hydrogen to refine those biomass and the bio oil and use cooking oil. So definitely there is a kind of new use case that we see there. There's still mandates that are being pushed for ammonia co-firing in Asia. So that demand will definitely be picked up as well. Yeah, so quick point there.
Yeah, thank you. Thanks a lot. And also thank you for already starting to answer the questions that are coming in. I will now, I started reading the questions that were not yet answered, and think we have at least a record question asker, Mark McHugh. Mark, I think we will, at least I just realized we probably will meet in Paris on 26 May, where we will, if I understand correctly, you will defend the role of Brazil as an exporter of hydrogen. So at least kind of clarifying some of the context I'm aware of. You asked some questions to the panel, which almost seem as also asking, like, is this the way to do success, right? So let me maybe repack all these questions together and then go to the panel. So, dear panelists, so if an investor has $1 billion US, should they invest this in hydrogen, or what portion of that would you allocate to hydrogen? And I do realize, that's why I ask it to you, that your organizations advise not just on hydrogen, but a much broader set of energy vectors. So I'm hopeful you will, give a fair chance to other energy vectors out of that billion as well. So what portion of 1 billion would you like to suggest they should allocate to hydrogen projects? And then building on some of the questions of Mark McHugh, so are those projects that money would get allocated to, are they perhaps including as a success factor vertical integration? Is it, the ones which are moving first because, early movers will have an advantage? Is it the ones that are going towards power markets because that's where the opportunity is? So I've already grabbed in there, I think 3 or 2 questions out of the Q&A. So 1 billion, how much would you allocate to hydrogen? And what are the success factors of those projects that money would go to? How would you recognize them? I'll start with Markus, please.
Excellent. So how much you invest out of the billion depends on how much risk you want and how much return you want, and if you have access to very good opportunities. So I will answer your question by not answering it. Obviously, there are many investment opportunities in the energy space, and I think such a trade-off is very difficult to say, right? I don't think a specific number would be useful. Let me talk a little bit about what I would look for if I am an investor, because this is something I would, this would be my screen, my filter. I think it would be a clear path to a market, and that can be done through vertical integration. I think there are some very interesting concepts of people going all the way into high value added fertilizers with their products, for example, or there's close relationships with off-takers that then will create a green shipping product out of this and be able to monetize it somehow. Or you are a refinery that has an obvious use and a clear regulation to use that hydrogen. So a clear road to commercialization and an advantage in that road to commercialization, I think, would be one of my markers. The second marker would be execution capability. I think we talk so much about the advantage of having great renewable resources, and that's important, right? That is clearly important. We want to if you're building a green hydrogen project, you want to be somewhere where the electron actually has no other users, and it's therefore you can price it very close to cost plus. If you are building a blue ammonia project, you want to be somewhere where you have gas at very low cost, ideally a deep market to source it from. So yes, resource endowment is very important, but I think the second dimension that is often forgotten is about how good are you in executing? Do you have a track record of executing? Do you have the right technical knowledge? Have you done the necessary engineering, pre-engineering work? And do you have a concept to get to a competitive price point? I think one fallacy that we see is that developers start and say, this is a land with great sun and great wind. Let's start developing. Let's start and do a feasibility study. Let's do the early feed study. Let's get an early cost indication from an EPC. Then let's do the next level, next level, next level. The costs go up, the costs go up, the costs go up. And 3 years down the line, we've spent a lot of DevEx. We are at a cost position that is untenable. We have a project where we have invested a lot in an engineering concept that we cannot turn around anymore. And we have to cancel the project, and hard feelings all around. I think this is the wrong way to do it. I would very, very strongly push to do it the other way around, and from the beginning on have a very clear path to what is my cost position that I will get to? What do I need to do different to get to this cost position? And to compare that with the commercialization that I said earlier, right? So if I know the price of ammonia to be in that end market, for the number is 800, right, or 900, I need to have a very good path, including buffers, to get to that number, and not the hope that somehow someone will pay a lot more for that. So that would be my second very big marker for selecting any projects and for the way that things are built. And we see huge variations here. We do benchmarks on actual projects. We help clients with value engineering on their projects. There's huge variations in capex costs between plants. We are still very early, right? People haven't built this successively and haven't optimized it. So huge variations in cost. And I think the third thing I would look for is infrastructure, is a route to market in the technical sense. Do I build that hydrogen project right next to my off-taker and I can build a pipe over the fence, or can I maybe upgrade my product into a e-methane and put it into the gas grid? That's great, because then I'm not dependent on many other players to move forward. Or am I building a project where someone needs to build actually a port and an ammonia plant and a cracker, and someone needs to get the ships ready and make sure that I can trade internationally? This creates a lot of hurdles. They can be overcome, but they make projects so much more difficult to execute and so much more risky. And it's a source of risk that is often underestimated. So that would be my fourth marker.
Very good, very good. Now, Markus, I really liked your 3 responses. Just to offer you for the next time you would get such a question, you could have gone for 1 billion allocating based on the future role of hydrogen in the energy mix in 2050 and just say somewhere between 10 and 15% projection, so proportionate to energy mix. I think
that's a great point, Erik. But I think one thing is that unfortunately most investors do not invest in a 2050 time horizon, but they look at the next 5 to 10 years, right? And I think that's a little bit where my markers come from. But you're right. If you take a very long-term view, that could be a good stick in the ground.
And just to disclose my interest, I personally, I over Christmas, somebody gifted me €6,000. So I bought 50 hydrogen stocks, and now I'm tracking them. Because I always, at least personally, felt, when we all involved in a hydrogen, we have to do what we preach. So that's why I'm also very, let's say, invested with this question. So thank you, Markus. For now, moving to Murray. Murray, so 1 billion, how would you go about advising investors look at that, and how much of that and why should go to hydrogen, or perhaps zero?
Yeah, I mean, look, I think the reality is, I think right now, trying to convince someone that they should put a majority proportion of that into low carbon hydrogen would probably be quite a tough sell at the moment. I think rather maybe the way to think about it is if I had to deploy $1 billion into something across hydrogen or hydrogen derivatives, where would I put it? And I think, you know, I think if you'd asked me that a year ago, I would have probably been inclined to say, you know, some of these US Gulf Coast Blue projects, we certainly in our valuation modeling look robust. I think importantly as well, many of those projects have optionality in the sense that they have an existing domestic market. Some of them have access to some of those big pipelines that can take the ammonia up into the Corn Belt, and then they've also got export opportunities both into a European market where, you know, we're predicting higher carbon costs in the future, but then also that opportunity to capture some of those premium offtake markets into Northeast Asia. You know, right now, my answer probably would be a bit different. I think it would still be quite, you know, would probably be more looking at something, you know, maybe green hydrogen into the refining sector in Europe, where some of those investment cases look a bit more straightforward because of the way that the policy has been designed, and there's a little bit more certainty to the types of return, even for what are still relatively high cost projects in some of those markets. But you know, certainly what we're also seeing, I think it should be noted, is that, you know, if you can secure tax credits, production subsidies, you know, the returns on the projects we're seeing are anything from 8 to 15%. So it goes back to the point Markus made that, you know, some projects are better than others, and there are some fairly strong projects out there that have done a good job to lock down costs and have got the right project design. They're in the right location for a variety of reasons. But then maybe the other point I wanted to touch on, you know, related to, I think, one of the questions that came in from the same person was around the sort of vertical integration question, and I think it is a really good question, because what we're seeing is a bit of a difference in approach there. And actually some of the, you know, Air Products again being a good example where they have had to, you know, they've tried to, on that Louisiana clean energy project, they have really tried to do full vertical integration, but that's also proving quite challenging because they're trying to do the hydrogen production, the ammonia loop, the carbon capture, the carbon management, and they've actually stretched their capital across so much of the project. That's also now something of a challenge, and they're also entering into things that maybe they haven't got as strong a track record as an ExxonMobil off. So, you know, there's also an argument to say that, and we're seeing this across a lot of companies at the moment, is that, you know, really try and refocus on your core, you know, really focus on the things that you are good at project execution on and find the right partners. And I think, again, finding the right partners is really important when we're looking at the opportunity to get into the European market or to capture some of those auctions into Northeast Asia. Partnerships are going to be really important in terms of having project success there.
I have absolutely, particularly on the last thing, I absolutely agree. And just to help our organizers also, I think that's one of the, well, frankly, to me, the only reason to go to conferences still in person is actually that partnerships require trust, and trust we build in person. So I would strongly advise people still to occasionally go to conference and shake a real human hand, or at least be in the same room as other humans, because yeah, that's how you build trust, and partnerships are really key in this industry. Let me go to Min, and Min, your final reflection, and then afterwards I will ask each panelist to close it down to do a hashtag sentence they'd like to leave audience with. So, but Min, first to you, you have a minute to offer your reflection how we should go about investing $1 billion.
So investing $1 billion or 100 billion, I think, you know, just to borrow the words of my colleagues in consulting, it depends. It depends on many things. But one of the things that I think hasn't been mentioned is actually the profile of the company, the exposure of that company, what is the sector that company is working in, and the region that the company is working in. Right? If we look at the renewable developers, for example, that will be quite a different case compared to, let's say, an oil and gas players, right? In terms of the exposure they have. And another thing as well is the horizon of their investment. As Markus mentioned, most investors are looking at 5 years, potentially 10 years. No one looking at 2050. But if you start looking at 2050, then the case for energy transition aspect, hydrogen and so on, become a little bit stronger as well. If you are a renewable developer, for example, especially in market where there is strong renewable penetration, like in Europe, where your capture rate for your solar plant or your wind farm continue to decrease, you do need to find ways to potentially increase the value of your asset, right? And hydrogen and green molecules could be a way there, even though you might not get to the double digit that oil and gas players are used to, but you surely could be seeing a bit higher as well. So that's one of the aspects. And if I were to, looking at a company and a supply chain, again, the story changes a little bit as well. How is their business currently structured in terms of what equipment they're providing to so OCTG players will be different to a solar module manufacturers. We see many solar module manufacturers in China now starting to expand their business to provide electrolyzers both in China and overseas, right? The like of LONGi, Trina, and so on. So there's certainly, a push of some of this investment there to also help with their traditional business and exposure as well. So I think that's the key question, where you are located, what is your current exposure, and what is your commitment to some of the goals that we have in the long term.
Very good. I think we definitely always also need to know the profile of, and it goes to partnership remarks as well, and how do we get to commercialization. So drawing this all together, what is the final sentence you want to leave as a hashtag our audience with? So I'll go to Markus, then to Murray, then to Min. We live in the age where, well, at least my teenage children tell me, Dad, if you're speaking longer than 30 seconds, it doesn't fit my TikTok. So, Markus.
It's going to be all of the above. I think one of the dangers or problems is that we are losing nuance and that we are doing either or recommendations and thinking in boxes. And I think when we talk about hydrogen and other technologies, we need all of the above in the next decade.
Absolutely. Let's not lose nuance. I like that. Okay, Murray.
Yeah, I'd very much agree with that. That there's a lot. It's very. This is really difficult. It's really complicated. I think the one thing we kind of boil it down to, and a lot of the projects that we're seeing trying to approach FID and trying to get across the line, the big challenge is just not just securing offtake, right? It's about securing an offtake agreement that is more than 2, 3, 4 years, right? That is where that's what's really holding a lot of projects back at this very moment in time, even where there is a subsidy or a tax credit in place. So maybe my hashtag would be something like hashtag secure long-term offtake.
Excellent. And then Min, what would be your hashtag to leave our audience with? And then afterwards we move to organizers.
Yeah, I will say hashtag focus on the details, hashtag enjoy the challenge, and hashtag don't lose hope. There was one more, but I kind of escaped my mind at the moment already.
Absolutely fine.
That's right. I remember sick advice from us.
I think, well, if today was not convincing that there is a stellar advisors out there, then I don't know what is convincing. I'd like to invite from the audience a round of applause, and then I will, on behalf of the audience, do this for the panel. So thanks so much. Dear organizers, well, with a 5-minute delay, but that's still fashionable, I'd like to thank the organizers and pass on for any final remark and conclusion.
Right, so thank you to all 4 speakers for this dynamic and thought-provoking exchange. What we've heard today reinforces that meaningful progress in hydrogen will depend not just on the vision, but on shared mechanisms of trust, transparency, and coordination, whether between companies, between regions, or across international partnerships. These reflections set a solid foundation for the more technical and sector-specific dialogues that will follow. So, as we wrap up today's discussions, it is evident that hydrogen remains a cornerstone in the global energy transition, not just as a decarbonization factor, but as a driver of regional competitiveness, cross-sector innovation, and industrial resilience, redefining market strategies to rebuilding investor confidence and fostering pragmatic collaboration. Our speakers have provided a timely snapshot of where the hydrogen economy stands and where it needs to go next. Looking ahead, we anticipate accelerated alignment between infrastructure development, demand creation, and supportive policy frameworks, as well as deeper cooperation across public and private actors. The road forward will not be linear, but today's dialogue reminds us that progress lies in shared ambition and actionable pathways. This is only the beginning. We invite you to stay engaged with us at upcoming Investing in Hydrogen 2025, taking place this September in London, where we will reconvene with industry frontrunners, government stakeholders, and solution providers to translate today's insights into tomorrow's milestones. So let's continue shaping the future of hydrogen together. Finally, on behalf of Leader Associates Impact, I would like to express my sincere appreciation to all our esteemed speakers for sharing their deep expertise and strategic insights. I would also like to thank our engaged audiences for your participation, thoughtful questions, and valuable contributions. And again, thank you once again for being part of today's session, and we're looking forward to seeing you in London.